Hi, and welcome to this week's market presentation. Latest news. Over the past week, we have seen prices decreasing across most European natural gas and electricity markets, with the decreases more concentrated in the short term, particularly for the coming 2 to 3 months. Looking at the midterm trends, we know mostly neutral price evolutions, although Q4 of 26 and Q1 27 are seeing still a bullish trend over the past few weeks for both natural gas and most electricity markets. Looking at the latest energy news, we focus on the Iran war. At the beginning of last week, US-Iran tensions escalated further, particularly following military strikes in Lebanon by Israel and by the US against Iran, particularly following the downing of a US attack helicopter by an Iranian drone near the Strait of Hormuz. Nonetheless, as the week progressed, progress towards reaching an initial agreement to end the conflict appeared closer than ever. And over the weekend, it was announced that an initial memorandum of understanding that would see an end to the active conflict being reached, with the signing ceremony set for June 19th. The text of the memorandum of understanding has not yet been released, and there are differing versions of the text being reported on by both the US and Iran. But the deal appears centered on the following conditions. First and foremost, the reopening of the Strait of Hormuz and an end to the US blockade within the following 30 days that could see a resumption of commercial transit through the Strait of Hormuz. At the same time, the US will waive economic sanctions on Iranian oil exports, allowing Iran to sell oil undisturbed by US economic sanctions. There are also reports that at least a portion of Iranian frozen assets ranging from between $10 and $25 billion will be released over the coming 30 days as well. And very importantly, a ceasefire in both Iran and Lebanon will be extended for 60 days as final negotiations regarding the nuclear issue, broader sanction relief, the status of Iranian frozen assets, and other issues taking place during that time. Now, any agreement that is signed on Friday will remain fragile, with key questions remaining unanswered. First is going to be whether Israel will respect the terms of the ceasefire in Lebanon moving forward, a topic that Israeli government officials have said they will not feel that they're tied to any agreement, and they could continue pursuing military actions against Hezbollah in Lebanon, putting a continued peace deal under question. Then very importantly will be what the status on Iran's stockpile of highly enriched uranium will be, as well as what other economic concessions will the US have to make. Overall, the impact on energy markets was as it has been rapidly felt. Oil prices initially surged towards $100 a barrel for Brent on supply disruption fears when escalation of tensions appeared to be in sight, before Brent plummeted over the weekend to below $84 a barrel, a 3-month low on the back that an agreement had been reached and that the signing will be coming soon. Financial markets also rallied on the reduced geopolitical risk and also on the prospect of lower inflationary pressure with the decrease in energy prices. Nonetheless, the situation remains very uncertain, and until a deal is reached and the terms are followed, we could see further volatility in the markets. At the same time, central banks, particularly in Europe and in North America, are grappling with the surge in inflation since the start of the war and what actions to take. The European Central Bank raised its key interest rate by 25 base points, with the European Central Bank commentary seen as more hawkish, prioritizing lowering inflation over concerns over economic growth. Over in the US, markets are expecting for the Federal Reserve to keep rates unchanged, even though inflation for May did surge to 4.2% year over year. Although we do see that the inflation did ease month over month, and at the same time, the US did see a slight reduction in Q1 GDP growth as well. Overall, energy markets, financial markets, again, as mentioned, have reacted positively to the developments towards an end to the conflict. And we did see rising bond yields and falling equity markets earlier in the week before recovering later over the weekend. The Nasdaq did experience its worst session since April 2025 on rate fears, although those have certainly eased over the last couple of days. The European Central Bank hike and forecast revisions signal a tougher stance on inflation, and certainly the Federal Reserve will see certainly how that plays out. Weather. Looking at the latest weather forecast, a new heat wave is expected to hit most of Europe with temperatures as much as 10 degrees above the historical average through the middle and beginning of next week. Precipitation, which again remains limited, especially in the Nordics, has again put a difficult outlook for hydropower generation in the region, although some more precipitation is expected through the weekend and beginning of next week. Wind speeds as well are expected to lead to strong wind power generation, especially in Germany over the course of this week. Microeconomics. On the latest microeconomic indicators, we saw a downward revision of US GDP from 0.5% Q over Q growth to 0.4% for the first quarter of the year. Over in Japan, we also saw Japan's seasonally adjusted GDP shrinking in Q3 25 versus Q2 25. On inflation data, we saw increases in inflation across the euro area and the US, with US inflation now at the highest level in 3 years. Although, as mentioned, we did see inflation ease slightly in May versus April. And we also see that the increase in inflation has been attributed primarily to the rise in energy costs. And as the war appears to be ending, and we could see a potential decrease in oil prices, could give reasons to the Federal Reserve to halt any interest rate hikes, at least in the short term. Crude oil and LPG. Moving next towards crude oil and LPG prices, we note the downward movement in crude oil prices, both in West Texas Crude and Brent. As mentioned earlier, as of last Friday, Brent fell down to $87 a barrel, and as of this Monday has traded down further down to around $84 a barrel. West Texas Crude now trading at around $80 a barrel. Again, this would be the lowest levels in over 3 months, and although still higher than the prices that we saw prior to the start of the war, we certainly see crude oil markets pricing in a resumption of crude oil flows through the Strait of Hormuz soon. At the same time, the U.S. continues its release of crude oil from the Strategic Petroleum Reserve, pushing levels to the lowest levels we saw in 2023, and before that to the lowest levels since 1983 as well. Here, the continued decrease in crude oil inventories was certainly raising concerns over more impactful physical flow disruptions. But again, the expected agreement between the US and Iran easing much of that risk. Natural gas. Looking at natural gas prices next, we see slight downward movement there. Overall prices were strengthening through the beginning of the week as tensions escalated between the US, Iran, and Israel before decreasing as that deal between the US and Iran appeared closer than ever. So far today, on the back of the expected signing this Friday, June 19th, we saw natural gas prices falling further throughout today. The decrease is certainly more felt in the short term, with the front quarter seeing the largest decreases over the past week, frontier remaining a little more stable. European gas storage levels remain at a deficit versus last year, with the deficit increasing slightly over the past week. But overall, we've seen injections into storage continue over the last few weeks, pushing storage levels to around 45% full. The injection rate remained in line with the past 13-year average, slightly above the levels we saw in 2023 and 24, but still below that of 26. This has certainly been a positive development, facilitated by the decrease in total natural gas consumption in Europe, pushing to 5-year lows, which has helped balance the market given the worse supply situation we have currently due to the decrease in LNG imports. But when we take a closer look at total supply, we do see that the decreasing LNG sendouts has been compensated to some degree by the increase in Norwegian flows as maintenance across the gas infrastructure in Norway progresses. There was an unexpected outage over the past week that saw that slight decrease in flows over the last few days, but overall, maintenance is expected to continue ramping up, and we're expecting to see Norwegian gas flows increasing further over the coming weeks. And lastly, looking at investment fund positions, we did see a relatively stable picture over the past week. Certainly, as we look to the resettling of positions throughout this week, we could see a decrease in net long positions as a result of the expected agreement between the US and Iran. Coal. Looking next to coal prices saw a decrease over the past week, especially in the later half of last week on the back of expectations of an end to the conflict, and certainly on the back of the decrease in oil and natural gas prices. Over in China, however, we're still seeing a significant coal consumption due to gas to coal switching there. Keeping prices in Asia still elevated. Over in Europe, however, we are seeing area coal stocks at now the highest levels since January of 2025, facilitated by one, the decrease in natural gas prices, but also the strong renewable power generation, reducing power sector demand for coal. EU and UK emission allowances. Looking at European and UK carbon allowances, limited movement over the past week overall, but nonetheless prices remaining at relatively higher percentiles, yet following the decreases that we saw over the last couple of months. Overall investment fund positions in Europe saw a slight increase in long positions there, while in the UK we saw a further decrease in short positions as pressure on prices continues to mount following the continued progress on linking the EU and UK carbon markets. Emergency actions to boost the industrial sector on the European side of things, with the potential to increase supply by 400 million tons, also adding to some of the bearish sentiment in the market. Electricity. Looking at electricity prices next, we see relatively stable evolution over the past week. Certainly the decrease in gas prices weighing on electricity prices, but nonetheless, we're still seeing prices supported by the higher carbon prices as well. Again, the downward movement more concentrated in the short term due to the drop in gas prices, but at the same time, concerns over summer demand and supply, especially given the poor hydropower generation outlook and concerns that the higher river temperatures in France will lead to a reduction in nuclear power output, are adding further support to prices during the summer. Across European markets, we saw a similar evolution where overall prices had been on a gradual increase over the last couple of months, but over the past week seeing a little more stability. A couple of exceptions being France and Spain. They're seeing slight increases still over the past week. Over in the Nordics, a slight decrease over the past week, but nonetheless, Nordic power prices remaining supported by the poor hydropower outlook. European total grid demand remained in line with the past 5-year average, with non-dispatchable demand supply remaining stable over the past week, still at a record high for this time of year, while residual load saw a slight decrease there to 5-year lows. Looking at non-dispatchable supply, we note that increase in wind power generation over the past week, which compensated for the decrease in solar power output there, although solar power remaining now at 5-year highs. Hydro run-of-the-river generation remaining below the past 5-year average. In terms of dispatchable demand there, we see that decrease in fossil fuel power generation as a result of the stable demand and slight uptick in non-dispatchable and renewable power output, as well as an increase in nuclear power generation over the past week. Nonetheless, looking at hydro reservoir generation, we see that remaining at 5-year lows, and again, the outlook for the summer remaining poor. Lastly, looking at guarantees of origin, we saw a further decrease over the past week. Overall prices have now moved roughly 13 to 15% below the levels we saw a month ago for 2026 and 27 production years. But overall, still looking at a bullish trend over the last couple of months in particular, following the sharp increase we saw since the middle of April. Overall, we're certainly seeing prices finding support from the persistent Nordic hydro deficits, although certainly the increase in renewable power output over the past week and the positive outlook, particularly for solar power generation, easing some of the supply tightness and some of the upward pressure on the market. That covers this week's market presentation. Thank you for joining.